Did you know that tariffs can reduce global investment by up to 2% annually? That's billions of dollars wiped off the table, money that could have been fueling innovation and growth. But what does that mean for your investments? Let's break it down. Welcome back to Simply Money. If you're concerned about the impact of tariffs or a potential economic downturn, here are some steps investors can take to prepare. I want to give you some practical examples and some things to keep in mind as we go into this new year unsure of what the tariffs could do to our economy. There's a lot of fear and speculation going on, and I want to give you some solid advice for how you can weather the storm. This isn't a political channel. I'm strictly looking at how can we weather the storms that politics bring our way on a continual basis. News cycles, politics, things like that are constantly causing the market to ebb and flow. People respond to the market, people respond to the news. And here on Simply Money, we want to set a game plan up that can help you weather these storms and ride it out so you can reach your financial freedom. Let's look at some of the ways that you can help deal with the uncertainty and the impact tariffs could have on your investments. The first thing is you need to just make sure your portfolio is diversified. With or without tariffs, your portfolio should be diversified. As the old saying goes, don't put all your eggs in one basket. Spread investments across asset classes like stocks, bonds, real estate. But as we teach here on Simply Money, don't try to look for the winning stock here or there. Diversify through index funds or ETFs, mutual funds if you have those available in your 401k. These are automatically diversified, but also in those indexes and in these ETFs, make sure that they are diversified, that they have a large array of these funds, whether it's stocks or bonds, real estate, using REITs, whatever the case might be. Make sure that you're spread across many different asset classes. And on the same note, that brings us to number 2, focus on defensive sectors. Make sure that you're diversified in different sectors. Look into sectors less sensitive to economic cycles, such as consumer staples, healthcare, and utilities. These tend to perform better during downturns. Don't put all your money in tech stock. Don't put all your money in finances. Make sure that you're diversified not only with assets, but with sectors as well. A good index fund could be heavily skewed in one sector. I like index funds that have a balance of different sectors. I have different index funds that make sure that my diversification reaches these various sectors. So one index fund may be down while the other one's doing well and vice versa. These help balance the storms of financial uncertainty. Number 3 is maintain or increase your cash reserves. A lot of people don't have enough cash reserves. I don't think you should hoard cash because you're going to just erode its value as inflation continues to eat away at its value. If you have $100 put in a can and buried in your backyard and go dig it up in 10 years, now that $100 isn't buying the same amount. You need to be earning interest. If you do have cash, first, make sure that it's put into something that's earning interest, a high yield savings, a money market, somewhere that you can still get access to it quickly, but it's earning interest at least at inflation rate or close to it to enable it to maintain its buying power. But build this liquidity as a safety net for volatile times. You should have at least 3 to 6 months worth of expenses saved in a liquid form, somewhere accessible, so you can get to it in case you lose a job or other emergencies arise. But if you're concerned about high volatility, a really bad downturn in the market, build up a little bit higher. Maybe you get 12 months. If you're financially independent and you don't have a source of income, perhaps you have 2 years worth of liquidity somewhere. That way, if the market dives and it's down for an extended period of time, you can draw and live off of that liquidity, that cash, and not have to eat away at an already deteriorating portfolio. Again, this depends, and all financial advice depends on you and your circumstance. I'm not a financial advisor. This isn't financial advice for you to do exactly what I'm saying. You should take this as an outline, as information to figure out for you and what's good for you and where you're at. You could be 25 years old. You could be 65 years old. You could have two incomes. You could have one income. You could be self-employed. All sorts of factors play into how you're going to determine what is best for you in these situations. Number 4 is evaluate your exposure to tariff-affected industries. Review your holdings in sectors most affected by tariffs, such as manufacturing and agriculture and consumer goods, and adjust exposure as needed. I wouldn't overly tweak your portfolio here, but it's just something, again, to look into. If you're really concerned about it, perhaps you make sure that you have a well-diversified portfolio, that you're not heavy in these sectors, and that your diversification hits the other consumer staple sectors that we spoke about a minute ago, to diversify and help balance that. Manufacturing, agriculture, consumer goods may take a hit, and the others may rise. We don't know. Nobody knows the future, and this should be planning that you do on a regular basis anyways. How are you invested? How are you diversified? How are you weathering the storms? How do you weather storms like COVID? How do you weather storms like 2022? How do you weather storms like the dot-com bubble? How do you weather storms like the housing bubble? How do you do that? By diversifying, by making sure that you have a plan and that you stick to it. Number 5, and I'm going to say this with great caution, is you look for value opportunities. Because during downturns, that's a big flashing red sale sign going on. High-quality stocks with solid fundamentals often trade at discounted prices. So be ready to take advantage of these opportunities. And again here, I would be cautious with just picking a single stock. You can get these same bargains with ETFs and indexes because certain sectors are downturned, maybe the tech downturn, perhaps financial downturns. And a sector is down, that's where you can find an ETF that is very cheap and on sale, and you can buy more or get exposed to these during this time. Number 6 is strengthen your fixed income holdings. This is things such as bonds, and bond ETFs in the portfolio to provide stability. Consider things like TIPS, Treasury Inflation Protected Securities, to hedge against inflation risk. Again, we don't know what the outcome of tariffs will be. We don't know what the outcome of a new president will be. There's always uncertainty. We don't know what world events will transpire that could make the market go up or down. We don't know the future, but we can make plans to ride out and weather these storms. If you're not sure about how to do that, check out the video I've done here that shows a hypothetical investment in various different ETFs, and it shows the highs and lows and helps get a visual of the psychological and the emotional roller coaster that you have to endure, but it helps you see the long term in these different areas. If you had quit too early, if you'd got out of the market, what you would have lost and what you would have missed. And so it's a great video of showing and visualizing the long-term approach to investing. And that brings us to number 7, is to avoid emotional decisions. Just know that throughout the history of the market, there's been downturns. Stick to a long-term investment strategy and avoid panic selling. During volatility, panic selling kills investors. That's why most people lose money on the stock market. They're either trying to find the winning stock, put all their money into one stock, and it goes belly up. They're trying that get-rich-quick type mentality, or they panic sell. They put their money, they have a well-planned, thought-out process, they're diversified, they put their money in the stock market, and the stock market as a whole has a downturn, and they panic. In March of 2020, so many people lost money in the stock market because when it turned down with the COVID fears, people pulled their money out, they locked in those losses, and guess what? By July, August, September of that same year, it had recovered and exceeded where it was at, and they lost that opportunity. Don't panic. Regularly rebalance your portfolio instead of making reactive changes. Go in, make sure if you want to be 50-50 in a ETFs, whatever your portfolio looks like, make sure it's balanced. Good thing about strong ETFs and index funds is they're doing the rebalancing for you. You don't have to worry about that as much. You just have to make sure that your sectors and where you're invested is continuing to provide your overall long-term plan. Number 8, stay informed. Monitor how tariffs and economic policies impact specific industries and overall economy. Staying updated helps you make informed decisions. But don't get overly news responsive. Like, I turn on the news and you can go to any channel, you can go to YouTube, you can go to any major news cycle, and there's going to be bad news about the economy. Why? Because bad news gets ratings. Bad news brings responsiveness. Bad news is what they sell. Yes, there could be a recession. Yes, there could be bad things coming, but the news pushes that. People on YouTube use that to try to hook you in. I'm here to tell you, yes, we're going to ride through some bad times, but be positive and know that this will pass. We don't have to be knee-jerk reacting to every news cycle that comes out, because our goal is a long-term plan, and staying informed is helpful to see maybe how sectors and assets are changing, but it should not impact your long-term goals. It should only help inform you on making better decisions, not knee-jerk reactions and fear-mongering reactions. Number 9 is, if you are so concerned, you're fearful, you don't know what to do, consult a financial advisor. I'm not real big on financial advisors. I think there's so much information that you can get on your own. But for some people, numbers just don't compute. For some people, it's a fear factor. They want another set of eyes to check it. They want to make sure they're on the right page. There's nothing wrong with that. A professional can provide personalized strategies tailored to your goals and risk tolerance during uncertain times. This is a great time to go check with a financial advisor. But make sure that they are fee only. Don't let them charge you continually for what money that they are holding. Make sure they're fiduciary, where they have your financial outcome, your best interest at heart. They have to take that into consideration. It's not about what's selling the best commission for them. They have to do that if they're a fiduciary. Make sure that you are getting a fee-only service, that you go consult them. They're going to look out for you in your best interest, not what will keep the most money under their management for the longest amount of time. And number 10, think long term. Economic downturns are often temporary. Maintain a long-term perspective and focus on consistent investment growth. Again, you're not in the stock market. You're not investing for a day, a month, a year. You're investing for long term, 5, 10, 15, 20, maybe 30 years. I don't know how old you are, but you're not having to worry about the next year or two. Now, if you're retired, if you're financially independent, and your only source of income is your portfolio, that's where you need to have your portfolio hedged and make sure that you have sectors and assets that are helping hedge in case of a recession or in case of a major downturn. That's where your planning changes. How I would invest as a 25-year-old is radically different how I invest now, which will be slightly different how I will invest when I'm 65 or 70, because the goals, the life, everything is different at different time frames. At 25, I have all sorts of time. I can ride out the worst downturns. In fact, at 25, if the market crashes 50%, I'm going to be scrounging as much cash and liquid assets as I can to put into the market for the recovery. Not saying to do that, but that's what I would do. Looking at things from hindsight, it's easy to know what I wish I had done when I was 20, 25 years old. But guess what? At this age, I'm now looking at, I've seen it. I've seen all the ups and downs of 55 years of the market. I've seen that type of stuff, and it's okay. It's going to happen. Long-term perspective. So do tariffs have you freaked out? Are you afraid of what may come? Make sure you take advice and seek counsel on how to protect your portfolio. Do your research, do your due diligence. Don't fall for anything that's quick and easy, Becoming wealthy is a slow, steady process when you invest wisely. Protect your money. Don't try to take risky chances on getting rich tomorrow. Make sure you're investing in long-term ways that continue to grow and ride out the downturns, because the downturns usually springboard into record highs down the road. And that's where we're at right now. We're at record highs. It's going to drop, and it's going to go back up. Look at the market. Take graph of the stock market and look at 1 year. Look at 5 years. Look at 10 years. Look at 30 years. Look at 50 years. As you see that up and down, the ups and downs become smaller the more you pan out. It's like looking at a mountain range. When you're real close to it, the peak seems so high and they look so low. As you drive away from it and you look back, it's like looking at the stock market from 5 years, 30 years, 50 years back. The further away you get, those peaks and valleys don't look as big and as intimidating. And that's how you have to approach the stock market at your index funds, your ETFs. Don't look at the month or the year results. Look at the big picture and see, and let those balance you and realize, yes, it goes up long term. What do you think of these tips? What do you think of the tariffs? What do you think tariffs are going to do? Throw your comments down below. I'd be interested in the community sharing what their thoughts of what's going to happen in 2025 with tariffs and with the economy as a whole. None of us know. Put your opinions in there. That's fine. Keep everything cordial. Let's have a cordial discussion. Let's help each other navigate through the uncertain times. Guess what? In the long term, you too will be financially independent, and you can look back and say, you know what? 2024, 2025 wasn't all that bad. It was scary in the moment, but we rode through it because we were diversified, we were prepared, we were informed. That's it for today on Simply Money. Hit that like and subscribe button, and we'll see you next time.